Debtors and creditors ratio analysis. This has already been covered earlier this year, but is revised here as it's also relevant to debtors management. In addition to the age analysis of debtors, calculating the average time it takes for debtors to pay can also be very useful. In addition, this can be compared to the time taken to pay creditors to help one understand the cash flow of the business. If you are able to keep your debtors collections and ideally stock turnover as well, less than the creditor's payment period, you will need much less investment in working capital. In other words, you need less short-term cash in your business. To calculate the average debtors collection period, you need to use your average trade debtors divided by credit sales, where these figures are available, and then times it by the days in the period that you are referring to. Assuming that your credit sales is for a year, you will times it by 365, as there are 365 days in the year. If you are not able to find specific trade debtors, you can use trade and other receivables. And if you can't find credit sales, you can use the total sales figure. However, you need to realize that your answer will then not be as accurate as it should be. This shows the average period a business has to wait before being paid by debtors. This is very important as it shows how credit is regulated in the business and can have a great effect on the liquidity of a business. Importantly, you would of course need to compare the actual debtors collection period to the terms that are offered in order to determine how well the debtors are being managed. The average creditor's payment period is calculated in a very similar manner. However, in this case, you will use your trade creditors compared to your credit purchasers. As above, if you can't find trade creditors, use trade and other payables. And if you can't find credit purchases, you can use your cost of sales figure, as this would be the closest available amount that you might be given. This is similar to the calculation above, but it calculates how long the business usually takes to pay its debts. Creditors usually allow between 30 and 120 days for accounts to be paid. Again, you would need to consider what are the actual terms offered by the suppliers in order to determine if this is suitable or not. One wants to take advantage of the terms offered by creditors without extending your payments over that period of time, as this could create animosity with the suppliers, and it's much better to build a good relationship with your suppliers. Let's have a look at example 8.9. Number 1. Sales for the year totaled R1,000,000, of which 40% was on credit. Over here we are told the percentage of credit sales, and so for our debtors collection period calculation, underneath the ratio, you can work out the actual credit sales as 400,000. In addition, in information number 3, you are given your balances at the beginning and at the end. You are given the actual debtors control figures, which is what you want. These are your trade debtors. You need to average them, as these figures need to be compared to the 400,000 credit sales for the year. So the beginning of the year balance and the end of the year balance are added together and divided by 2 to get an average of 22,500. You then times it by 365 days in the year to work out that on average debtors pay within 21 days, which is not bad at all. Number 2, the business uses a markup of 100% on cost and have accounts with all their suppliers. In this case, you would need to use your sales figure and divide it by 200% to get your total cost of sales of 500,000. Since all the suppliers offer the goods on credit, this total amount will reflect your credit purchases. In the same way as you had to average the debtors balance, you need to average the creditors control balance. So you will use your 30,000 and your 45,000 divided by 2 to get the average of 37,500. Again, times by 365, and you will see that on average it takes 28 days to pay creditors. Both of these periods are healthy when compared to normal terms. Usually, terms are 30 days, although this may be slightly longer for suppliers. However, if it was a case of debtors being given 14 days to pay, as is sometimes the case, you would then realize that you have a problem. We are not given this information, so we can assume that it is acceptable. The fact that the debtor's collection period is a full week shorter than the creditor's payment period allows us to use money received from debtors to pay the creditors, and this allows the business to benefit from the borrowed money to finance the credit offered to debtors, especially since all the purchases are on credit and only some sales are offered on credit. You should now be able to do exercise 8.10 and summative assessment 8.12. Remember that 8.12 is exactly the same format as a test you might receive. So please make sure that you are able to do it without referring back to previous exercises and in the time limit allocated.